Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 142. And in this episode, we're reviewing the performance of the global markets during the second week of 2025, and that is from Monday the 6th to Friday the 10th of January 2025. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the growth in the U.S. labor market was much stronger than expected in the month of December, which in turn reduces the prospect that the Federal Reserve will continue cutting rates in 2025. According to data released by the Bureau of Labor Statistics, non-farm payrolls, which measures the change in the number of people employed, excluding the farming industry, this number increased by 256,000 new jobs in December, and this was up from 212,000 jobs in November and was also above the consensus forecast for 155,000 new jobs. In the meantime, the unemployment rate was down marginally at 4.1%, and the employment data for the last 2 months of 2024 shows that the U.S. labor market remains robust and raises questions about the future direction of monetary policy in the United States. Staying in the U.S. labor market, earlier in the week on Wednesday, ADP, which is a payrolls processing company, reported that job creation in the private sector eased more than expected in the month of December, whilst wages grew at their slowest pace in nearly 3.5 years. Private companies added a seasonally adjusted 122,000 new jobs in December, down from 146,000 jobs in November, and was even lower than the consensus forecast for 136,000 new jobs. On the monetary policy outlook for the United States, the minutes of the Federal Reserve's last policy meeting in December 2024 were released on Wednesday and showed that central bank officials expressed concern about sticky inflation and the impact of Trump's trade policies on the U.S. economy. Consequently, due to the increased uncertainty, Federal Reserve officials indicated that they would be moving more slowly on interest rate reductions in 2025. For your information, President-elect Donald Trump has signaled plans for aggressive trade tariffs on China, Mexico, and Canada. In the foreign exchange market, the US dollar rallied on Friday after data showed that the US economy created more jobs than expected in December, reinforcing expectations that the Federal Reserve will pause its rate-cutting cycle. Consequently, the euro dropped to its lowest level versus the dollar since November 2022 and was down for the second consecutive week and was last seen trading at 1.024 versus the greenback. And based on a recent Reuters poll, a significant number of foreign exchange traders expect the dollar to reach parity with the euro during the course of this year. Moving over to the Eurozone, data released on Tuesday by Eurostat showed that the annual rate of inflation in the Eurozone rose for a third consecutive month to reach 2.4% in the month of December. This reading was in line with the market forecast and marked an increase from the revised rate of 2.2% in November. Meanwhile, core inflation, which excludes volatile food and energy prices, this held steady for the fourth consecutive month at 2.7%. Headline inflation was widely expected to increase after hitting a low of 1.7% in September as base effects from lower energy prices begins to fade away. This increasing trend in inflation will be closely watched by the European Central Bank, which is widely expected to cut its policy rate from 3% down to 2% during the course of this year. And over to the United Kingdom, where long-term borrowing costs hit their highest level in almost 30 years following the auction of a 30-year Treasury gilt on Tuesday. This move came after the UK Debt Management Office auctioned off about £2.25 billion worth of gilts with a 30-year maturity. The yield on the 30-year gilt rose by 3 basis points to touch a rate of 5.212%, which was the highest rate recorded since 1998. For your information, a gilt simply refers to a UK government bond. In the People's Republic of China, before the market opened on Friday, the People's Bank of China, which is China's central bank, announced that it was halting the purchase of Chinese government bonds. The central bank said that it had stopped purchasing government bonds in an attempt to slow down the one-way bond trade that was putting downward pressure on the Chinese yuan. When the central bank purchases government bonds, that causes bond prices to rise and their yields to fall, and this in turn causes the yuan to depreciate. On Wednesday this past week, the yield on China's 10-year bond plunged to a record low, whilst the offshore Chinese yuan, which is traded in Hong Kong, hit its lowest level against the US dollar in more than 1 year. On Wall Street this past week, stocks dropped on Friday following the release of the hotter-than-expected jobs report for December, which dampened expectations for more interest rate cuts from the Federal Reserve this year. Traders are now pricing in a 97% chance that the Fed will stay put on interest rates at its next policy meeting that is scheduled for the 28th and 29th of January. Friday's losses pushed all the three major benchmarks into the red for 2025, with the Dow Jones Industrial Average losing 696 points to close at 41,938, whilst the S&P 500 slid by 1.5% to stabilize at 5,827, and the Nasdaq Composite fell by 1.6% to settle at 19,161. All of the three major averages posted back-to-back weekly losses, with the S&P falling by 1.9%, whilst the Nasdaq dropped by 2.3%, and the 30-stock Dow slid nearly 1.9% during the week. In the U.S. government bond market, U.S. Treasury yields jumped to their highest level since November 2023 following the release of the December jobs report, which came out much stronger than expected. The strong labor market data makes it less likely that the Federal Reserve will lower interest rates at its next policy meeting later this month. The Fed Funds futures trading is currently pricing in a 97% chance that the Federal Reserve will leave its policy rate unchanged this time around. Meanwhile, the minutes of the Fed's last policy meeting for December showed that officials were concerned about sticky inflation and the impact of Trump's proposed trade policies, and therefore indicated that they would be moving more slowly on interest rates in 2025. The yield on the 10-year Treasury bond spiked to its highest level since late 2023 as it added nearly 6 basis points to close at 4.74%, whilst the yield on the policy-sensitive 2-year Treasury note surged by more than 10 basis points to settle at 4.36%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil jumped on Friday after the U.S. Treasury Department announced sweeping sanctions against Russia's oil industry. The sanctions are targeted at Russian oil companies and their subsidiaries, as well as more than a dozen Russian energy officials and executives. The Treasury has also sanctioned more than 180 tankers, which are part of Russia's shadow fleet that has been dodging existing sanctions against the country's energy exports. The U.S. Treasury Secretary Janet Yellen said that the United States was taking this sweeping action in order to destabilize Russia's key source of revenue that is being used to fund its war against Ukraine. In response to the foregoing, the price of the global benchmark Brent crude gained by about 3.7% to close at $79.76 per barrel, whilst the U.S. benchmark West Texas Intermediate crude advanced by about 3.6% to settle at $76.57 per barrel. In the precious metals market, the price of gold rebounded on Friday as uncertainty surrounding Trump's trade policies boosted the safe haven appeal for bullion and overcame a stronger than expected U.S. employment report that reinforced expectations that the Federal Reserve may not cut interest rates as aggressively this year. One of the main factors supporting gold is this uncertainty about Trump's trade tariffs, which, if implemented, could fuel inflation and further limit the Fed's ability to lower interest rates. Gold is considered a good hedge against inflation, but high interest rates tend to diminish the appeal for this non-yielding asset. In summary, the price of spot gold was poised for a weekly gain of more than 1% and eventually came to a close at $2,688 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at Kenya's economic growth in the third quarter of 2024. According to the Kenya National Bureau of Statistics, the Kenyan economy grew by 4% in the third quarter of 2024 compared to a 6% growth in the third quarter of 2023 and was the slowest growth rate since the third quarter of 2020 when the country was in lockdown due to the COVID-19 pandemic. The slowdown in 2024 was largely due to a contraction in the mining and construction sectors as well as a deceleration in growth across most sectors of the economy. For example, the agriculture sector, which is the mainstay of the Kenyan economy, grew by 4.2% in the third quarter of 2024 compared to a growth of 5.1% for a similar period in 2023. Meanwhile, the services sector recorded a growth of 5.3% in the third quarter of 2024 compared to a growth rate of 7.8% for a similar period in 2023. In the domestic foreign exchange market, during the past week, the Kenya shilling continued to hold steady against the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.47 compared to 129.31 that was recorded the previous week. Meanwhile, the sterling pound was priced at 159.74 and the euro was valued at 133.31. And on the regional front, one Kenya shilling was changing hands for 28.61 Ugandan shillings and 19.23 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.81. The dollar-shilling exchange rate appears to be reverting back to its previous static rate of 129.20, where it was for about 2 months. This price action, where the dollar-shilling rate is trading within a very narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt that now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves decreased by $20 million for a total of $9.178 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remained under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. In the interbank market, the liquidity situation in the interbank market was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased by 6 basis points to 11.12%, up from 11.06% the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 30.9 billion shillings, up from 25.1 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 28.8 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 9th of January, and the central bank received bids totaling to 33.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 138%. And the results of the auction were as follows. The 91-day rate declined by about 23 basis points to average out at 9.59%, whilst the 182-day rate was flat for the third week running at 10.02%, and the 364-day rate dipped by 3.6 basis points to settle at 11.33%. Up next is our topical issue, and this week we are looking at Kenya's move to regulate cryptocurrencies. The National Treasury has issued a draft national policy that will guide the regulation of cryptocurrencies and digital tokens in a bid to curb tax evasion, fraud, and cybercrime. In the spirit of public participation, the Treasury has published a draft national policy on virtual assets and is now seeking input from the public that is expected to guide the development of these proposed regulation. For your information, a virtual asset is a digital representation of value that can be traded or transferred digitally and used to either settle payments or make investments. The draft policy sets out the guidelines for the establishment of a sound legal and regulatory framework that provides the foundation for a fair, competitive, and stable market for virtual assets, with the aim of fostering innovation, enhancing financial literacy, and ensuring sound risk management. The Treasury is alive to the fact that virtual assets have gained traction in the country due to the public's desire for alternative investment options, as well as the speed and cost effectiveness of cross-border transactions and their pseudo-anonymous nature. In releasing the draft policy, the Treasury noted that without regulation, the use of virtual assets presents various potential risks such as money laundering, terrorism financing, tax evasion, fraud, and cybercrime, and also raises issues around consumer protection. The Treasury Cabinet Secretary said that these risks underscore the urgent need for a comprehensive legal and regulatory framework to govern virtual assets and ensure the safety and integrity of Kenya's financial system. The development of this draft policy signifies Kenya's shift from trying to ban the use of virtual assets to ensuring their safe and sound use in the economy. And that is a principal aim of this policy, which is to cement Kenya's role as a major player in the global digital ecosystem. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, in whatever you attempt to accomplish, what really matters is whether you did your best. Think about it. Thank you, and God bless.